In this episode, I want to address a topic that's often overlooked, but may hold the key to your future business success. Some would suggest I skip this topic or risk losing my audience because it's boring and most don't understand it. But it's so important that I just can't ignore it. Ready to nail down a win on stage 10 of this year's Tour to Profit? Let's get into it.
Welcome to Why Business Teams Fail and How to Avoid It, a show helping small business owners build a radically engaged team that can run the business without you so you can remove the stress from owning a business and enjoy the freedom you deserve. Now, here's your host, Rich Allen.
Today you'll learn that many business owners are looking in the wrong places to determine if their business is doing well financially. That if you're going to be successful in business, you must know how to interpret the financials of your business, and that once you understand how to read the critical financial measures of your business, you'll make better decisions and make more profits. Here's my question for you this week. How do you measure the financial health of your business? If you're just now tuning into this podcast, welcome. So glad you're taking time to join us. We're working our way through what I call the Tour to Profit, a 52-stage race to grow your business. It's the title of a book I wrote some 15 years ago, and I'm refreshing each topic as we go throughout the year. Each week we cover one specific topic that will help you transform your business into one that will win the race against your toughest competition. This week is stage 10, and I want to talk about your financials. Now, before you tune me out, I want you to know that this will not only be painless, but I promise you that you'll learn something that will help make your business even more profitable and sustainable. Deal? Let's dive in. Can you agree with me that if you want your business to be successful over the long term, that your business must be in good financial health? It's not unlike your own body, where if you want to be active and truly live as you grow older, you've got to maintain good physical health. If you're like most who care about their physical health, you pay attention to things like your diet, your weight, your fitness level, your stamina, your flexibility, and your posture. These things all play a part in the total picture of how healthy you are. If anything gets out of balance or out of alignment, then your performance and your enjoyment will suffer. Well, the same thing is true about your business. There are certain things that you should track and measure that are indicators of whether your business is financially healthy or not. Unfortunately, many business owners don't know what these indicators are, and as a result, they find themselves dealing with an unhealthy business, but they have no idea what they should do to make it better or healthier. This week, our assignment is to fix that. I'd like to share 4 critical financial documents that should be a regular part of your ongoing financial review process for your business. I'll explain what they are and give you a few indicators to look for on each that will help you get a good sense of how healthy your business is. But before I get to our 4 critical financial documents, let me tell you the one financial document that is not among the 4, your checkbook balance. I don't mean to say that the balance in your checkbook is not important. Clearly it is. But it's not an indicator that tells you whether or not your business is healthy. Yet far too many business owners make important, costly decisions using only their checkbook balance as the indicator of whether they should say yes or no. This is certain to get you into financial troubles, especially if you're ignoring the 4 critical documents we're discussing today. So set your checkbook balance aside for the moment, and let's dive into the 4 documents that I think matter more that you should be reviewing and analyzing regularly. Let's start with your profit and loss statement. This is typically called your P&L. It's a point-to-point measure of how profitable your business is. Typically, it's measured monthly, but with online tools such as QuickBooks or FreshBooks, it can be measured at any interval. I share the P&L first because it's perhaps the best indication of how healthy a small business is, particularly one that's operating on a cash basis, meaning you're making entries based on the receiving or dispersing of cash. Your P&L shows your revenues by type at the top. If you have multiple revenue sources, this is a good way to see which revenue source is generating what level of new income for your business. Below revenues are your cost of goods sold. These are the costs that relate directly to the manufacture or delivery of your products and services. The relationship between your revenues and your cost of goods sold is called your gross margin. This ratio tells what percentage of your revenues are available to cover your overhead costs and provide a profit from your business. A typical gross margin for a manufacturing business will be in the range of 35 to 45%. A typical gross margin for a service business will be in the range of 60 to 70%. Knowing your gross margin will help you determine whether you need to increase your prices or reduce the costs of raw materials or labor that go into generating your products and services. Below gross margin are your operating expenses. These are sometimes referred to as SG&A, or sales and general and administrative expenses. It's common to measure your operating expenses as a percentage of your revenues for the period. A smaller, more startup-like business may have an operating expense ratio in the range of 30 to 40% of revenues. This is high, but over time, as your revenues grow, this percentage will go down as these operating expenses should remain fairly stable. A more mature business should operate with a 15 to 20% operating expense percent of revenues level. The bottom line on your P&L is your profit. Ideally, you should be able to generate profit in the range of 10 to 20% of your revenues. Some service businesses are even higher, and some product businesses may be slightly lower. But if your bottom line is not at the 10% of revenues or higher level, some changes in how you run the business may be in order. The second critical financial document is your balance sheet. Your balance sheet is a point-in-time measure of things and stuff, your assets, what you owe, your liabilities, and what you own, your retained earnings. Every financial transaction in your business impacts your balance sheet, yet most business owners never give this much thought or show much concern about it. But when you get ready to transition your business to someone else or sell it, your balance sheet will have a huge impact on the value you receive for your business. Ideally, you'd review this financial document at least quarterly with the goal of increasing the value of what you own in the business by increasing your things and stuff and reducing your liabilities. The third critical financial document is your budget. Every business should start each year with a budget. This is a picture of what you plan to accomplish financially in the business. A budget allows you to forecast revenues by type, cost of goods sold, the costs related to creating the products and services you provide to your customers, and what you expect your overhead costs, your operating expenses, to be as you go throughout the year. A budget is important to your financial health in that as you progress through the year, you can compare what you had planned would happen financially in your business to what is actually happening in your business. This allows you to see the differences early and ask the important why questions. Why is your revenue off in this area? Why are your cost of goods sold higher than expected? Why is your overhead higher or lower than anticipated? By comparing your actual results to your budgeted forecast, you can identify problems make changes and adjust future plans before things get out of hand. The fourth critical financial document is your cash flow forecast. As the name suggests, this is a period-by-period projection of your bank account cash balance. Typically, this is updated monthly, and if done correctly, will allow you to determine if you have enough cash to run your business over the next several months. I often meet with business owners who aren't sure if they can even make payroll or if they have enough cash to buy the necessary materials to fulfill their obligations to their customers. A cash flow forecast will help you see the future and allow you to make better near-term decisions. The top of your cash flow forecast will show you how much cash you have on hand right now. The next section will show you how much cash is projected to come into the business and when. Typically, this is shown either monthly or sometimes even weekly. Where your incoming cash comes from is important to forecast. Will it be coming from the sale of your products and/or your services, or will the cash be coming in from financing or borrowing? Or do you anticipate the cash coming from a capital infusion, someone putting cash into the business? The next section will show you how much cash is projected to go out and when. This will show the projected purchases for your raw materials, your production labor, your overhead expenses such as rent, payroll, insurances, fuel, travel, and the like. By identifying all the sources and uses of cash for each period, you can then calculate your expected cash balance at the end of each period. This is a quick way to see if you're going to have enough cash on hand to continue to operate the business without having to tap into your line of credit or find cash from another source. It's far better to have this cash flow forecast rather than simply wait till your bank account balance gets too low to pay your bills. So there you have it, 4 critical financial documents that we as business owners should all be using, updating, and measuring on an ongoing basis. Your profit and loss statement, your balance sheet, your budget, and your cash flow forecast. By using and monitoring these 4 critical documents on a regular basis, you can make sure your business is financially healthy and you can make the necessary adjustments in your business before something reaches the critical stage. Knowing that your business is financially healthy gives you the peace of mind you need to enjoy being a business owner. It can also relieve you from the stress of having to make difficult decisions at the last minute. As we wrap up today's podcast, let me leave you with these simple thoughts. Number 1, while your business bank account balance does matter, it should not be the document you use to make big financial decisions about your business. Number 2, there are 4 critical financial reports that you should request, require, and review regularly to guide your business. Your profit and loss statement, your balance sheet, your budget, and your cash flow forecast. And number 3, once you gain financial mastery, you'll make better decisions faster, and your competition will be left scratching their head on how you became so successful. If you'd like some additional support as we ride this Tour to Profit race or want to tap into our free resources, simply go to my website, tourtoprofit.com. You'll find everything you need there. Thanks for joining me today. Be sure to tune in next week when we're going to discuss Stage 11, Delivery Mastery. You won't want to miss it. Now, go make it a great week, and whatever you do, ride hard.
Thank you for listening to Why Business Teams Fail and How to Avoid It. Make sure to like, subscribe, and tell your friends so you don't ever miss an episode. Now go make it a great week, and whatever you do, ride hard.